Today we are joined by Mr. Bhuvan Gupta, and he is the manager of Client First Capital based in Dubai and has generated 22% annual average returns since starting the fund. He is also a strong believer of Rule 1 investing, where the only rule is to not lose money. He has a bachelor's in computer engineering and has an MBA finance with a specialization in wealth management, further honed through his tenure at RAK Bank in the UAE. Aside from investing, he also likes reading a lot and he's working towards getting a black belt in karate. He lives in Dubai and I would like to thank him for joining us today. Okay, so I will also give an introduction of myself now. So I am Raday Jala. I'm 15 years old and I'm a grade 10 student at Raffles Institution in Singapore. And it was really nice meeting you in Omaha for the Berkshire AGM this year. And I've been interested in investing for the past 4 years and have now written my own book on value investing, which focuses on compiling the great teachings of many value investors on various topics such as mental models, life, and investing. This book is not published yet, and I am to publish it at the end of this year. Um, so, with this, we can get started right away. And I would like to first start by straight away asking you how and when did you start your value investment journey? And having a engineering background and a bachelor's in computer engineering, what made you switch, and how did your engineering background help you in becoming a value investor? And what challenges did you face switching from that background to the finance world?
Thank you, Ajay, for having me here. First of all, I'm very happy that at the age of 15, somebody is writing a book and he's very much inclined towards Warren Buffett. I think I got late. So you have a huge career in front of you because compounding needs a lot of timing. You need a lot of time, not timing. Coming to my introduction, I think I don't deserve that big introduction. Just managing $30 million, and yes, people have made money through us, but all roads point to two people, which is Peter Lynch and Warren Buffett. They are to be credited for whatever I have done because the noise is so much in the field. It's not easy to concentrate. So, what led me to the value investing is a very simple thing. I wanted to be an honest guy, but I also wanted to be a billionaire. Now, with wrong means, making money is very easy, and I'm sure we see a lot of companies becoming billion-dollar company or unicorn overnight. And then we also see all this Forbes 40 under 40 going down the drain behind the jail. I was very clear that I wanted to have my reputation intact. I am not a person who can handle 1,000 people or 10,000 people and become like Infosys, TCS, or let's say Microsoft. But I can actually, so I just wanted to say that I'm not a great IQ person. Yes, I have been a topper throughout, but I don't think so. I'm cut out for a workaholic culture. I wanted to mimic a model where I can play my sports, I can do my karate or my boxing, I can take care of my health, and I can be with my family and still make the money. I think Warren Buffett interested me the most. I did not reach to him directly. How did I reach him? Is first I was approached by a lot of people from this Indian firm called Motilal Oswal. From there, I met somebody called Ramdev Agrawal. If you get a chance, you must interview him. His net worth is roughly 5,000 crores. His liquid net worth is 2,000 crores, which is only in the stocks. He and I belong to same place. When you meet somebody from your own place and who is much ahead of you, and he is also on the same path as you are, you really get a shock of life on the positive sense. And I was really envious with Ramji Agrawal, though he is 30 years elder to me. And I said, I should meet this person, I should learn from this person. Thanks to Motilal Oswal, we did a good job for them. We raised a lot of money for their private equity and equity funds. And we eventually reached there. And then I met Ramdev Agrawal, he's such a simple man, such a great guy, and he made investing so simple. And I just watched his video on the YouTube. And then after meeting him, I realized that becoming a billionaire is a simple story. Being a millionaire, people really get crooked. And from Ramdev Agrawal, I learned that Ramdev Agrawal gets the inspiration from none other than Warren Buffett. When you read about Warren Buffett in so many books, you are compelled to meet or attend his events. And that's how I landed up to Omaha, and it's my third year. And I think when I go there, I am trying to tell each and everyone in this world that we all deserve a 15 to 20% CAGR, or a compound annual growth rate return. It is not a rocket science, it is not a high risk. And investing has to be low risk, high return. I hope, now coming to challenges, is that there are many challenges. I think this podcast will be smaller for those challenges. But all I can say is that I would love to not to buy a car, but to invest my money in the stocks. I do not want to spend my money to have a grand life right now, but I want to create that value, because this is the only way to leave a legacy and also create a wealth. Not, I'll not say the area, it'll be a nation where everybody around you will be inspired by you for the decades to come. And I think this path is very well where customers don't lose money. They might see a notional loss of their money. Like you talked about Roku. If a company is great, if a portfolio is great basket, you might lose 30-40%. Like in COVID, we lost money. Last year, we lost money. But everything has come back. So anybody who's invested with us for more than 2 years is making money thanks to Warren Buffett and Peter Lynch. I think I answered your question.
Okay, thank you for the question. I think you touched a lot of great points there, especially regarding how even Warren Buffett says that our biggest superpower is being honest and being accountable and being there for someone when they need it. And I think they have inspired countless generations. And I think to carry that legacy forward, it's really that I think you'd definitely be very, very proud of. And yeah, and as you said, when it comes to money, the first 100 grand is the hardest to make because you really need to do as much as you can to get that money, and then after that, compounding really just does its work over a period of time. Right. So, my next question is because of these challenges or because of any other problems, because when you're coming into the investing world, you're new, and a lot of fad stocks, a lot of hype stocks, get carried forward, and you get interested in making quick money. So,
The biggest investment mistakes you made, and what were some lessons you learned from these failures that can also be later down in your career? And really, what were the essence of those challenges?
So there are a lot of mistakes you ask me. I cannot name them in a few one. But let me tell you the biggest mistake. Buying a Fed stock, only you'll understand what mistake you've done. So I bought this stock called Charlotte Web Holding, which is in the CBD oil, and it claims to help people who have got stress or epilepsy. My mistake was I read about this stock in one of the subscription website, and I think that it's a great changer. And I know about CBD because CBD has come from India in 1960s. But what I forgot is that time I did not have a checklist, and because of checklist, I go wrong on the valuation. And because of that, this stock which I bought for roughly 7 to 8 Canadian dollar has become now $0.25 or 0.25 cent. And I kept that stock with me still in the current portfolio because I wanted to be reminded of my mistake which I have done. So I think this is one of the biggest mistake I have done. Uh, Other mistakes, if I will name it, I have actually corrected them also very in a very good manner. So this is one of the biggest mistake. There's second one more mistake I will tell you: never listen to the clients, specifically those who have very short-term focus. So the part of the world I belong to, people are trading mindset because there is no taxation, and they want to see money growing every month or every day. So the second mistake which one should not do, and I think I've done that and I've learned out of that, because everybody has a cycle here there. What I have done, you will also do it. Now you may do it. Why should I be party to it? Just because I'm making some extra bucks, I should not become party to it because I already know that is wrong. So what happened is some of my clients also want to do trading, and we entered in the China market and we trade for them and we made money. And then we again bought this Chinese stock because they were cheap. And what happened? China busted 3 years ago or 2 years ago. And then what happened? This money is there. There is no problem from the client side, but the problem is on the attention side because your attention get divided. So you're writing your book. I should have finished my book by now and published at least 3 or 4 books at this age. But what's happened is these kind of things take your what do you call attention. The third thing is like derivative trading. I really don't get involved with it, but as a business, we have this derivative desk also. I will say all these are unnecessary. But what happens is Bitcoin, startup, and all these things come to your life every day because everybody want to sell you something. So these distraction are the biggest issues. But if we really want to be a value investor, we have to say no to roughly 95% things. So these are my mistakes. The biggest mistake I told you, and I think in the future I'll again do mistakes. But a best way is to make a checklist, do it the way you are also okay. So how do I really make money for people? So Terry Smith said, it's not about the fees. It's when somebody invests as a fund manager exactly where the clients invest. So my majority of my wealth is invested in where clients' money is invested. So I have no conflict of interest. That's how one should manage public's money. That's my opinion.
Yeah, that's very true. I think Mangai talked about the importance of incentives because they can drive you to do things in manners that you don't really understand because the power of incentives is so big. So you talked about your mistakes regarding the valuation in the beginning and not being able to really be able to analyze it at the right valuation or come up to a correct range or correct number. So, um, so a bit more into that. So, are there any key financial metrics, financial ratios that you currently look out for, which defines your valuation and of a quality company?
Fine. So I'll first give you the answer to my engineering background because the first question you asked me how my engineering background is helping me. So I am help. This is helping me because I understand technology. Because I'm a computer engineer. So and now every Amazon or whatever we talk about, they all are technology. So I think to understand cloud or artificial intelligence is very easy for me as compared to anybody who is not from this background. So that's how my computer engineering is helping me out. So I understand the CRM technology. I understand the cloud. This is an advantage. Now coming to your question on what is my evaluation metrics. So in my opinion, value investing has three legs, and this I had derived from Chuck Akre, who is managing $17 billion out of America. So three legs or three-leg stool is one is the quality. People approach the value investing or investing through price. So a very good book, Diamond to the Dust, and I think let me market this book in also. So Saurabh Mukherjee wrote this book called Diamond to Dust. Amazing guy, managing 10,000 crore out of
Yep,
India.
yep.
Yeah. And what's very important, he has mentioned that when a stock price gets corrected, like Yes Bank or let's say Divan Finance Housing, the retail investors pounce on the stock. They think that it is cheap and it will make them money overnight. So the whole crowd is busy in buying something which looks very, very cheap. But as Peter Lynch said in his book, that if your stock is at $10 and it's gone to $8 and you think that it might not go to $2, let me promise you it will go to $2. So 10 to
Yeah,
2 is very much possible. Just by looking at the price, you cannot be sure. So what we do now, we first look at the balance sheets, the cash flow, and the income statement. So quality check. How do we check the quality? When I'm investing in a business through share market, I'm actually becoming a partner to that promoter. I do not have really a physical thing to say here, but if I would have invested, let's say, in your business or you would have invested in my business, it would be a physical share on those particular. So if you have, let's say, a $10 million worth of furniture, and if I am 10% partner, $1 million of worth of furniture is mine.
yeah,
Share market works that way. So let's ignore the share market. Look at the company. When you look at the company, what exactly happens is the promoter has to make money. If promoter is not making money on his capital, if I make the money, it is just a fluke, like you have seen in the GameStop or you would have seen in the Robinhood on the starting days of Robinhood. So what happens is first criteria is to see whether the promoter is making money or not. How do you see that? You see that by two metrics. One is the return on capital employed, where the promoter has put in his equity and also the long-term debt. So you combine that figure and see how much they have got from the operation before tax. which we also call NOPAT. Now, there could be a fudging here. So, better ways to also look at the cash flow yield. So, how much cash flow the promoter is actually getting, the free cash flow or the cash flow divided by the debt plus equity, which is the capital. And when somebody is doing it for the 10 years, the past 10 years, because you can't see the future, you
Yeah.
can only see the past to analyze the present. So the return on capital employed is the greatest measure, and the consistency of this is the important. So if 10 years somebody is getting an ROC of 20 to 30, and that's consistent, the first thing is this business is making money. The second thing is this business is able to deploy a lot of capital at incremental capital, because every year when you get this cash flow and you deploy that money into the business, your base gets higher
Higher.
and
Yeah.
make more cash flow. So it's getting technical here, but that's how the average ROC is important. And only the quality is not important. So let's say you bought a house for $1 million and your rent is $200,000. So how much you're making? 20%.
Yep.
What about the cash which is coming in your hand? It has to also make you 20%.
Yeah.
And that comes from sales or profits. Profits increase by when the margins are increased, because as you become bigger, your margin should go up, like HDFC or Asian Paints or Pidilite in the Indian parlance. In the US parlance, let's say Copart, Constellation, Apple. So when you look at their margins, even in the inflation, their margins are 20-25%. And I'm talking about the net margin. So if the free cash flow is growing, or the profit is growing, or the cash flow from operation is growing, that is called growth. The second leg of the stool called value investing is growth. So quality is over, growth is over. The last comes is the valuation. Now, in the valuation, there are multiple ways you can look at the valuation. Never look at the price to earning. It's the most flawed. Anything which is given in front of you, which everybody is seeing, is already discounted.
Yeah.
Everybody can see price to earning. And price to earning also, what is mentioned in the Yahoo or Google is price to earning trailing 12 months. So price to earning should never be seen. Now, how do I do the valuation? Peter Lynch said, if a company is growing at 40% and if the price to earning is less than 40%, you are buying that company at discount. That's one way. The second way is, if I buy this company at, let's say, because I'm just giving you a simple method. The second way is average price to earning. So during the 10-year period, if the company's price to earning is lesser now, and the company has what I just told you about the quality and the growth, then you can actually go and buy it. Since we are on the podcast, I'm not recommending any stock, but I'm searching a stock called Sartorius Biotech Stedim. And one can actually go and check if the price to earning is less than the growth. That's how, again, you can buy this company, because biotechnology still has a long way to runway to go. The second thing. Third thing is that discounted cash flow model, where you can actually do a discounted cash flow, because at the end of the day, a business is worth how much cash flow it can generate in the
Generate.
future. These are three methods, if you ask me, on the normal growth stock, but you will always buy them costly. And there is a, I will not take much time now. Let me answer this to the next question.
Okay, sure. So, as you talked about the quality of stocks, and that you need a business that is well run, and a large part of it, I think, is the management, because you have to know whether the management team is honest and it is disciplined. And nowadays, managers are, they are really smart people, so they're really cunning. So do you actively engage with management teams of the companies you invest in, and how do you go about with these interactions? What are some questions you ask them? How do you um, challenge them to really understand how the manager is like?
So Warren Buffett said those days that I'm mix of three people. I don't remember the third person, but the first one was Charlie Munger. The second one was a guy called. So the first one, oh, okay. So first one was guru called Ben Graham. The second was Charlie
Yeah.
Munger, and was
Philip Fisher?
Philip Fisher.
Yeah.
Philip Fisher gave something called scuttlebutt.
Yep.
Scuttlebutt means you meet the supplier, you meet the distributor, you meet the customers, you actually see everybody around you, think about the product, take the product feedback, and that's how you create whether this company is making an extraordinary product or not, or how is the culture. There's also one good saying that culture eats strategy over breakfast. What does that mean? So let's say you're writing this book just for the purpose of writing the book and making it print or by getting famous. This is a strategy to get into a good college. But let's say you actually feel from within that no, I want to manage people's money or my money and grow at 24% CAGR. And this is how I'm going to live my life. I'm going to curtail my expenses. Every money which my father is giving, I am not going to save it, but I'm going to invest it, which requires a lot of patience there. And the patience is the biggest behavioral key which everybody needs. And if you can do that, that's called culture. And if you can do that, like you interviewing me, you interview 40, 50, 70 more people, it will become an ingrained culture in you because you've spent a lot of time with people like me. I'm very small in the whole bouquet, but all I'm saying is that this will create the culture. So yes, we meet the management. Yes, we are behind the employees. We would like to listen from everybody and we take both the angle. So, for example, we love Tesla. There are a lot of friends we have discussed Tesla with. So, yesterday I test driven Tesla, and I'm very disappointed. Not with the technology, but the feeling of the car for the price I'm paying. So, all I'm saying is this is how we create our feedback. I cannot meet Elon Musk, but there's so many customers of Tesla I can meet. There's so many what do you call it, people who are the sales representative. You can meet them. For example, I'll give you a very good example. When you go to Amazon or Apple store, I don't know, have you gone to Amazon store in Singapore? But Amazon store and Apple store, when you will go, these people are quite knowledgeable,
Yep.
these shop representatives, and they never try to sell it. This talks about the culture of these companies. They never ever try to sell it. They are trying to educate and make you aware of the product and the information. And
Yep.
that's the key to a culture. So we meet the CEO, we write, ask them tough questions. We ask them what's going to happen next 10 to 15 years. We also make sure the companies we invest into, the promoters should have a stake in the company. We also see whether they're buying back shares or not. We also see that which kind of people they are. Are they somewhere practicing Warren Buffett? Do they like value investing? All these we see, and this is where the key of quality investing comes. We also look at the alter remuneration, the growth in it, the depreciation method. So yes, you're right, we also now seeing the board of directors and how diversified they are they relative or not. So a lot of, and we listen to them. By the way, Hriday, while listening to you, I can figure it out what exactly is going on in their mind. That is the key. So who said
Yep.
this? Tom Genner. I also meet the same people you meet, but when I meet them, my understanding is quite different than what your understanding is.
Yep. Yep.
And that comes from the spirituality. Though spirituality is all about inward, but once you become inward, and I see Hriday as me only, your name is Hriday, such a great name. So when I see yourself
Thank
in
you.
my heart, when I see yourself in my heart, I exactly realize what is the intention. And that's how I said yes. So when you meet this management, you hear about them. I don't think so many people can fake it. So in the starting days, I think at least for the next 10 years, I'll keep meeting this management. And then once we are so confident of our checklist, we might skip meeting them. I hope I answered a long answer, but useful.
Yep. Yep. That was very useful. Um, so for qualitative analysis, there are thousands of stocks in the market, and a lot of them, they're not similar investments that you can compare side by side, and you can say, oh, this is much better than this, unless, I mean, that's the case. But they're usually a lot of similar companies, and there's always an opportunity cost of holding a certain company instead of another company because you could have made that return from the other company. So how do you go about calculating and how do you go about evaluating this opportunity cost to decide that um, now is the time to go away because I'm missing out in too many opportunities, or now is the time to go into this because the opportunity cost is lower here than somewhere else?
I can give you an example. See, it's always that you like the girlfriend more than the wife. I know you're not married, but you'll understand this very well. Or maybe you like the ex girl. I don't know how to put it, but let's say I'll say that you'll always like the other car better than your car. Or maybe in your case, you will always like that what you have written is not better than what somebody else has written.
The grass is
So,
always greener on the other side.
so we're
Yeah.
always in this puzzle, but the data comes to rescue you. So I exactly know that there are 10 or 15 companies which are better than my companies. But since I also know that right now these companies are down not because of the micro but the macro effect. For example, China. China, we will never invest in the future because we have very small money. That's 40, $100 million, very small amount. And we don't want to really leave it to the Chinese government to open up or not to open up
Yeah,
with
yeah.
them. But it is whole political cloud which takes over. And we want to make money. The best markets to make money is democratic markets like India, America, and Europe and Canada. The best place where you want to invest is where the businessmen rule, where the capitalists rule. Like, for example, America has 25% tax, and I don't think so they will be able to increase tax, though they are suffering right now with the debt ceiling and all, but they will not be increasing the taxation. So, if I remember your question correct, I think you would like to ask how to choose between the new company or one in the hand and two in the bush. It's a very simple thing that if any company's figures are much better than the company you have, don't wait, change. But for that, you have to also understand that company's domain. So we have something called fish and pond theory. Buy a small fish in a big pond or a pond which is also getting bigger. So biotechnology pond is getting bigger. And a lot of people mistake here. Tesla is not a car company. And when you look at the Tesla, it's a self-driven technology where the what do you call the addressable market is too big. Tesla is bringing Optimus. That Optimus robot is not heard of. That's a big market. Tesla is bringing Roadster, and Tesla is also bringing trucks. So imagine if you calculate Tesla's market or the pond size, it is much bigger than the traditional car company. So first of all, one has to understand when they're investing what they're investing into, because Tesla will also bring solar wall. They'll also bring solar roof. They already bought, in fact. So what I'm trying to say, Tesla is not a car company. So one has to understand the vast domain. They have discussed with people openly. You know, one more thing I want to tell you. So when you go to see a car, let's say you tell your father that Papa, I went to see an iPhone. The second question he'll ask, did you buy it or not? But this is the issue. If we go to the market and research, and I just talk to 100 people about iPhone to make my own view, is something not heard of. But if you just do that, Hriday, like you're interviewing so many people, I'm sure you're interviewing a lot of people. Similarly, if I meet a lot of people to discuss one product or one company, my neuron changes. And once my neuron changes,
Yeah, yeah.
my that's why I said yes to you, and that's why we read so many books. Yeah. Next.
Yeah. I think Jason Zweig also talked about that, how at certain parts, certain things you do, your neurons get fire more than if you do certain other things. So
Yeah.
he did it around loss aversion, but I think you can apply it in this scenario as well. So this question is sort of similar to the previous question, but this one's more about how do you go about constructing your portfolio. So I think Pabrai and has said that he goes around saying, 10% is for 2 to 3 baggers of his portfolio, and then a certain percent is for 10 baggers, and the rest for 5 or 6 baggers. And also, are you more of the kind that likes to diversify, or do you like to concentrate your stocks into? Yeah,
Concentrate. I
yeah,
will not comment on Pobre, but if you remember, a few years ago, he got into something called Thomas Feld book 100 to 1. So what I'm trying to say that Pobre changed. He used to buy a company which is actually like a Ben Graham style, like
yeah,
cigar
yeah,
button, and he got changed. Yes, in my portfolio there are 20% companies where I would like to have a 10 bagger in 5, let's say 2 years or 3 years. but remaining my all companies are like forever. So majority of them are basically the quality companies and not the cheap companies.
Yeah. Okay. And do you are you using similar to Peter Lynch, the style where he has 6, 7 different baskets and then he puts it accordingly, or you just focus completely on the basket doesn't matter to you?
So Peter Lynch, I think if you're talking about the slow grower, the fast grower, talking about the stalwarts, the asset play,
Right.
that's the sixth. So Peter Lynch also has learned this in the earlier so later part of his life. You remember there are two types. So Fidelity did the research to figure out who are these customers who made the maximum money, and they found the two gentlemen who made a lot of money. One was dead, and the other has forgotten about the investment.
Yeah.
Same
Yeah.
happened with the Kirby also. In the coffee can investing paper when he wrote, so he used to handle a client's money, and the client died. And then client's wife said, "Please manage my money also." And then he saw that all the stocks he copied, but the bigger amounts, and he forgot to sell. Where Kirby sold, he did not sell, and those stocks have actually made extraordinary money, right? So Peter Lynch also learned this. If you read the book again, One Upon Wall Street, somewhere in the last 50 pages, he has written that later on in my life, I just understand that if a company is great quality, it will keep on compounding. So I think uh, it's a very simple thing to understand that now I do not do all these, but yes, I did some point of time, and I actually made a lot of money. I made 47.5% in 2020 by adhering to the advice of what do you call Peter Lynch, and I bought a company of P2, and the company name is Dinos Shipping. So I quote Peter Lynch. He says, if you buy a company at P2 or P3, chances of getting wrong is very bleak. And I listened to that advice and I bought this shipping company just to make double. I end up making 8 times.
Wow.
But given a chance, Harday, I will not do that because you always have this in mind that you have to sell, you have to sell, you have to sell. I want to
Yeah.
buy companies which are never to be sold. And for that, I will quote Chuck Akre. Chuck Akre said, every sell is a confession of error.
Yeah. That is I think a beautiful quote. So I'll ask you the last question because we're coming to the end of this podcast. So my last question is I think maybe a bit selfish, but what I'm basically asking is what advice would you give a young value investor or aspiring value investor like me or many others that are starting their journey into value investing? Um, yeah.
So there are two ways. One is the problem at the home itself. We are all being fed by with toys. Then we are fed with this TV and TV cartoon. That's anyway nothing but called spending because you have to buy a toy, and that is where our parents will spend money. Now,
Yeah.
listen to me, very important. And then what happens is that after the margin utility of the toy is gone, you as a kid will start crying. So now your relatives or your parents will again feed with you the new toy. And then they'll say that our boy is getting really, or our daughter is getting bored. Let's do one thing. Let's make him learn savings, or let make her learn savings, and then they will get you a piggy bank, or a gullak,
Yeah.
or a
Right.
box, and you start putting the money in that coin, like those coins, right? And then what happens is that after 5 6 years, you open it, and actually your money has become half because of the what's the word,
Oh, interest? No, sorry. Depreciation of the money. Right.
right? So my advice, and advice is always paid, but it is free to all the young children here out that please understand making your money grow at 12 to 15% is your right, is the moral duty of the parents to teach this to their children.
Yep.
When the Britishers came to India, they destroy our economy. Do you know the first listed company in the world?
I think it was a Dutch East India
That's
Company. Yeah.
not many people know it. So I want each children or each child to read the history again and read in the context of making money. Dutch East India Company was the first listed company in the world. They did an IPO in 1880. They bought ship with the IPO proceeds. The ship went to India, and their clothes from the India went to Europe. They were so famous. Each one of has a right to know the right history and implement that to make 12 to 15% return on their wealth, because anything below 10% is losing money.
Yeah.
That's my message to all of you.
That's beautiful advice. I'll keep that in mind. Going on in the future. So I think we'll end it here. And it was great talking to you. I got to learn a lot. So I'd like to thank you for this opportunity. And also, I hope to meet you again and do another similar podcast again, maybe a longer version where we can go more in depth into value investing and such life lessons in general.
So, Hriday, thanks a lot for having me. It was a pleasure to talk to somebody young like you. I hope my children will. So, I would like to also have the copy of it so that I can
Yeah,
also
yeah,
pay.
sure. Yeah,
So my children and all of my investors' children learn from you. I wish you all the best for the book, and any help you need for the book, let me know. And not only write the book, but let also people write book on you. And that's what Warren Buffett is teaching us. He did not write a single book. I always have this in my
yeah.
mind: should I write the book or not? But people have written a lot of books on him, and
On
that
him,
should
yeah.
be your goal. So all the best.
Yeah,
Don't stop. Don't wait. Let the books come in. Let the experience come in. Write about your experience in the book, so all the children can inspire. Because I think every children knows Netflix, correct?
yeah, yeah, yeah.
Be a child who owns the Netflix as a share and have made 10 times in the next 10 years. That kind of what do you call? I think you can do a great job, like Ryan is doing on the. You know Ryan, I'm sure.
Yeah, yeah.
Yeah. So what he's doing on the YouTube and making money, I think you can do in the wealth creation job. So all the best. If you're okay, I'll just hang up the phone now, and it's fine. If you have something, you
Yeah,
can off the.
yeah, yeah. Sure. Thank you. Thank you very much.
What's that? Take care. Bye.
Bye bye.